looking in a more educated way at trends that are emerging. We'll get to that in terms, pricing, leverage, and there are a number of headlines in the broader newspapers on risks evolving. Like systemic risk in leverage lending was just a recent hearing in the US House of Representatives where people look at this. Obviously, this is the syndicated loan market that is under scrutiny, but I think direct lending has a number of attributes which, and private debt for that matter in a broader sense, that should be just fundamentally sound.
The same. Welcome to the 2019 Germany PDI podcast. I'm delighted to be joined here by three leading figures in the asset class. Rather than attempt the pronunciations, I'm going to come to each of you in turn just for brief introductions.
My name is Hansi Baumann. I'm from Stepstone, partner, and I'm the co-founder of the private debt business line. I started this business line 20 years back, private debt and liquid alternatives, and that was under the name Swiss Capital Alternative Investments, and we merged 3 years back with Stepstone, a powerful private markets investment house.
Thank you.
Holger Graul, a partner at Yilco Investments here in Germany, focused on private markets in generally, alternatives, focusing on institutional clients. We've done this as individuals for over 15 years, investing in private debt, which is one core pillar of our firm's activities.
Okay.
Thank you. Alex Boulder, managing partner of PDI Alternative Partners, a Cologne-based consultancy. We are supporting all the smaller, highly regulated institutional clients in the DACH region and have about 2 billion assets on advisory.
Okay, great. Well, I'm going to ask you all to sort of dive in at the deep end, really. Some people might hold this question back to last, but I'm just going to come straight out with it and ask you what should be keeping people awake at night. But then, okay, maybe we'll soften it because we'll combine that with what still gives you faith and a positive feeling about the asset class today. That's George.
We oversee and manage 255 billion for investors all over the world. That means, anyway, there's a different risk appetite from most of the investors. But coming back, what keeps them awake, look, if you're invested in direct lending first lien, you sleep well, because obviously you're protected for market movements. If you're more on highly leveraged transaction, obviously, then the question is, when will interest rates start to raise? But obviously it didn't happen, the money is extremely cheap, so still everybody sleeps extremely well.
Okay, good. That's pretty positive.
No, it doesn't mean. It just means now that rates are low, they sleep well. I didn't say that rates will remain for the next 2-3 years on this level.
We can sleep well for tonight at least.
Yeah, that's good.
Okay. Other further thoughts on that?
I think it's the right question to ask, because I think there are a lot of advocates for the asset class, and it has received quite an adoption globally, has been embraced. So I think given the journey we've all been through, especially in direct lending as really the most prominent part of the private debt universe, I think the risk return profile has certainly suffered from the golden age of when the asset class has emerged. In Europe a number of years ago, in the US earlier, but I think it's still sleep well at night strategy. I mean, you cannot go much more conservative than senior debt in corporates. So given where the alternatives are in public debt, capital markets, leveraged loans, I think there are a lot of sound principles that are applied to investing in private debt that should make it for an attractive asset class for the long term. But supply demand needs to be kept in balance and monitored, and how that implicates the risk return profile.
For sure. So as long as there's safeguards there, looking in a relative sense, it's still looking pretty strong. Alexander, any additional thoughts on that?
Yeah, what might keep them, some investors awake is the fact that they are still not in the market for private debt or direct lending, and maybe miss the best part. As always in early markets, you can earn a much better profit than in later stages. And I think that's what we see now is a natural evolution. The market becomes more efficient, more standardized, and of course terms are deteriorating, or terms become just an efficient price for a certain financing. And what make them stay awake as well are reportedly the deteriorating terms, but in fact we are still on a good basis, I guess.
I think we'll come back a little bit later to talk a bit more about terms and conditions, because obviously that's something that's a major talking point at the moment. I wanted to ask you though about LP allocations, and I'm sure there's probably going to be nuanced answers to this question, but just to sort of take it down to its most basic level, do you think this is a time where LPs should be allocating more to private debt or less? I guess it depends on who you are, right, and what your situation is.
So it shouldn't surprise higher. But obviously there are macroeconomic factors and there are technical factors, and the other one is return expectation. From a macroeconomic perspective, obviously, I just mentioned before rates. If you expect rates to stay low for the next 4, 5, 6 years, not only for the next 12 months, then obviously you have a reinvestment risk. Where are you going to reinvest? Are you going to long duration where you have a lot of interest rate sensitivity? No, you wouldn't do. And if you invest short term in Europe, your return is 0. And in the States, it's maybe 2.5%. So on a return perspective, to do the reinvestment, you better go into private markets. That's one part. Second is, should rates start to move? You would like to stay short interest rate duration, but long contractual tenor. You don't want to be long duration. So it's good for if rates stay low, but it's also good if rates move. That's macroeconomic. The second is allocation. Look, people start to see that the public markets are not only expensive, it's very, very expensive. So you look for alternatives, and the alternative is really in private markets. The private debt, therefore, is a substitute, and people ask me what should be the right allocation. Look, the right allocation is you need to understand what you do. And if you do 1%, then you have 99% return pattern somewhere else. So clearly I say, if you go into private debt, you should be 5 to 10%. We have clients who are 15% and higher, but we have clients who are only at 1%. And by the way, we also have clients who have 0. So there is no allocation, the right size fits everybody. You have to find exactly where you stand in terms of understanding and integration, but do it strategically, not tactically.
From your sort of purview, which is obviously over a wide range of different managers and strategies, is your view, in general, that you look at certain institutions and you think actually their allocation to private debt should really be higher because, it does seem to suit their objectives?
Yes. Look, we have a very large insurance company, we have sovereign wealth funds, we have pension funds, and each has another starting point. Insurance companies are by definition fixed income oriented. So therefore, their fixed income allocation is anyway high. That means also that private debt is a fixed income replacement strategy. So that's one angle. By the way, these clients are happy with 6 to 7% on the dollar side if they have the lowest loss rates. Then you have pension funds who are also a bit more conservative these days, but they wouldn't be happy just with 5 to 6%. They would like to have slightly higher, and they can take also slightly higher risk. So therefore, the profile is slightly different. And fully different is with sovereign wealth funds and with family office. So profiling is extremely important. That's one. And second is to understand the evolution of the client.
Alexander, would you like to come in on this?
Yeah, absolutely. The allocation, I think, in general, a lot of people start with that asset class or in the beginning, and I think the one advice you always can give in alternatives is don't put your money all in 1 year to the market, but keep on investing every year over 10 years, and after 10 years in private debt a little earlier, in private equity a little later, in infrastructure even later, you get into a portfolio that really feeds itself and has a very good diversification in terms of assets, in terms of vintage years, and I think that then it starts really to make fun.
Mm-hmm. Okay, well put. Berger, any other points around?
Well, you were surprised. At the risk of also talking our book, we're all proponents of the asset class as we've seen it, how it behaves personally in good times as well as in bad times through the crisis with more junior-oriented strategies, which in the end actually performed surprisingly well, which is often forgotten at this moment. So I think the starting point for many investors is quite different by type of institution, by what they have done on the private equity side, and also a number of political, personal, individual factors. You see institutions that haven't done anything in alternatives and maybe get someone else at the helm to run the asset management and asset allocation, and people go quite aggressively into this. But I think people realize, whether it's in the insurance company sector or in the pension sector, there's really, in some part, a little bit of a pressure to go into alternatives to kind of reach the goals that they're set out to achieve. So I think you can debate if it's attractive, but on a relative basis, versus public market equivalents, I think it's quite attractive. Still, from conversation with clients, we see these debates are still live. Should we do $1 billion over the next 2 years through a liquid solution, maybe some hedged equity approach, or put it in illiquid strategies in a mix of private equity, infrastructure, debt? So these are live debates, and everyone comes out at a different result.
The pressure is given by the market.
Absolutely.
Obviously, it's not just an individual within an organization, because the public markets are expensive. You don't get any return. So it's really looking for alternatives on the return side, and obviously the private markets offer this type of premiums.
Okay, thank you. So we're here in Munich. Obviously, you're looking around the world. You're not just focused on the German market. But as we're here today, perhaps you could share some thoughts on how you see the evolution of the German market. We just had a presentation there on how debt funds have really, developed here and taken market share. What are your thoughts on the sort of positive and negative characteristics of the German market, and what would you say to someone who is asking about whether this is a good time to have a material exposure to the German private debt market?
Well, look, I represent the DACH region, besides many other regions in our company, and I'm Swiss, so therefore my market is not completely different than the German market. But let's start the following. The disintermediation process didn't start. Yes, at its infancy, it started in continental Europe, but in Germany and Switzerland, not. It's still a banking-dominated business. If, however, I move into the United States, the disintermediation started 30 to 40 years back, and clearly in the last 20 years it has accelerated. So the main driver is really the supply side. And this is not happening. So that means for the first lien investments, it's still a banking-dominated business. The second lien business, not, and the mezzanine. But for many of the investors, it's not the second lien and mezzanine they're looking for. They look for the first lien. So in a nutshell, the market is still expensive. That means spreads pretty tight compared for the same risk in other markets. And by the way, Switzerland is the extreme. Matter of fact, the returns that we get in private markets sometimes, not sometimes, quite often doesn't justify to go really into the institutionalization of the business. But the other side is the LPs in Germany. Look, they seek also returns. And that means they do not just have to invest in Germany. So a big part of their allocation is non-German oriented. In a nutshell, the industry is growing. It is growing, but still in Germany it is predominantly bank-dominated. Germany, Austria and Switzerland. Asia, by the way, the same. Allow me just to bring the disintermediation in Asia on private debt is not happening at all. In China, it is a banking business, only the NPL business, and there you can go in. But for performing loans, Asia is still too expensive.
I think the German market went through an interesting evolution, which in the beginning was quite interesting, as it was a little bit the new frontier for many private debt players that are more headquartered in predominantly London, but then also Paris. So everyone went to Germany, and it became a little bit, from what we observe, a battleground. So maybe in terms of terms and pricing, seen some deterioration, because everyone wanted to benefit from that catch-up effect. In the UK and France, the penetration of private debt versus bank financing was already at 50% plus in parts. In Germany, it was quite low and rapidly moved up to now in last year to 50%, at least when we look at private equity financed transactions. So the question now is going forward, with that kind of market growth through a catch-up effect has happened, it will be, the further growth will be more in sync with what we see in the UK and France. And the big question is, how long will it take, and will it ever happen, that we see kind of the relationships as in the US, where pretty much the market is divided among private debt players. So nearly 100% adoption of private debt, but I think that remains to be seen. I think for the time being, it has been in recent years a rather competitive market. Still, a number of new groups have had quite success in, if you will, reaching a very high market share in Germany, and it's interesting to see that at least some German LPs like maybe a higher allocation to Germany and in part have a preference for these funds. You could call this a home bias, or also maybe complementary to other funds that are more UK oriented.
But would you agree? I think there's still more demand than supply in Germany, because the German institution, they would be ready to invest larger into German Mittelstand first lien. But the supply side is not coping with the demand side. Yeah. That's the reason why the German LPs are seeking investments outside of Germany, which, by the way, is good. Diversification and all the reasons to that. But the demand side has not yet lived up to, for instance, with other markets.
Do you think, just out of interest, do you think that's likely to be addressed?
I think in Europe, yes, because if you just look at the cross-border business for banks with the new banking regulation, this has been reduced. That means for a period of time, this intermediation really happened there on the cross-border business. German banks lending into Switzerland and in other countries, this has reduced. But in general, the local business is still dominated by the banks. By the way, I'm not saying there are no opportunities for the private debt funds, but given the potential demand, there is not sufficient supply. Now I've been asked quite often, when will it come? No idea. I think it's only when really the cleaning up, the more drastic cleaning up of bank balance sheet is going to happen. Then, clearly, then it's the time. But Europe hasn't been as radical as in the States.
I fully agree that I think the market in Germany has been more bifurcated than in other countries in terms of the sponsored direct lending, which is an intermediated market, quite competitive. And then you have the banks who focus on really the lowest risk transactions for the vast majority of companies in the Mittelstand. And everything else in private debt regarding Germany are really very niche situations that are not at all scalable. And I would add that in other countries there's more creativity maybe and themes that are being picked up, whether it's the UK or other parts.
Just quick for Germany and Switzerland. Look, I come from Switzerland. Interest rates till 14 years is negative. Now you go into private debt, you see private placements being done at 0% to 0.5%. I wouldn't go into that. And then obviously if it's 1%, it's already good for some of the clients. But on the private debt side, there's a lot of work linked to that. And obviously you have to take into consideration also the fees. You see, Switzerland is even more extreme than Germany to that, but Germany is about the same.
Yeah, maybe there's only to add the German banking community is just about to try to resume some of the market by consolidating. It's Bremer Landesbank was consolidated with Oldenburgische Landesbank. In the south there are some bigger transactions, and and these groups are very active in the corporate lending market and are competitors to the direct lenders or to the fund managers. And in the same, in some areas, Volksbanken, Raiffeisenbanken, only very, very limited. And so Germany is still a very bank-inclined market. What is also due to the corporates, to the customer or the borrowers who like their relationship to the bank. What is 50 or 40 years old, but I think it changes step by step as I see the advantages of having an alternative lender who's more flexible and who can step in, step out, very flexible, or can just add a bank financing. And I think this is valued more and more. But still, we are in Europe. I think we are a little bit behind.
Okay, all right. So Berger, I think you used the word battleground to describe the situation in Germany. So at risk of losing friends here, I'm going to use the B word Brexit, the other B word, Brexit, and ask whether, in a way, that could make somewhere like Germany even more of a battleground, in the sense that perhaps investors are becoming more wary of the UK market, perhaps people even being advised to reduce exposures to that market somewhat, and whether that in turn would have side effects such as more capital flowing into other European markets.
I think the numbers that we're seeing, how capital is invested by funds, I think the general pattern hasn't changed. I mean, there were maybe bumps in the road for a quarter when the dislocation in the political discussion was highest, but overall, most pan-European funds, to take that as a prototype, they're doing 30-40%, in some instances even more in the UK. It's still probably the most advanced market and penetrated by all the funds. So there are some people who focus a little bit more on other markets, but I don't see this actually changing. What has been difficult, I think, for locally oriented funds that are active in the UK, they're more biased, I think, to the lower end of the market, where generally the micro topics of the credit fundamentals are in the end driving the results and not kind of any macro developments. I think they had trouble really winning investors outside of the UK pension world because people are just wary of, want to see what happens. But I think overall, I think it's been surprisingly calm in terms of what has happened so far. You'd have to think about FX risk, obviously, and a number of exposure to certain industries. But all the managers, when they do their due diligence work, are on top of that.
Look, I'm Swiss. Obviously, there's a political element, and there is a macroeconomic angle, and there's a microeconomic element to that. On the political base, I don't need to debate. Obviously, I'm Switzerland. I'm not part of the European Union. I just observe, and I have to say, I'm irritated to see how much instability all of a sudden really pops up. But that's a European issue. Now, obviously, UK has its own instability on the political basis. But when it comes to investments, obviously, it's pretty important to understand the legal system, because if I lend, I want to have my money back, and if the money doesn't come back, I want to enforce my legal rights. And the Anglo-Saxon system is anyway by far better than the rest of many of the European other legal systems. So from this perspective, is no deterioration. The repricing, however, on the transaction is happening on an ongoing basis. If the economic and the cash flow of the companies starts to deteriorate, spreads will widen. That's naturally, it's a repricing. And we haven't seen any stop or flow of transactions. In the contrary, we really see a lot of activities in the UK. As I said, Anglo-Saxon law, the disintermediation is really happening. The appetite of investors is here. Currency, that's another issue. You swap it out. So overall, it has not hampered at all the private debt market.
Okay. A pretty positive message I'm getting so far. Any
neutral.
Are you okay? Neutral.
Just a neutral, because the repricing will happen the moment there is more uncertainty to increase. Because that ultimately in private credit it is the cash flow.
Yeah.
You need to analyze the cash flow of the companies, and so far we haven't seen any strong deterioration. So I'm neutral to say the world has not changed to the extreme, not at all. The other part is, don't forget, money is still cheap. Money is unbelievably cheap in all the markets.
Okay. Would you concur with that, Alexander, or anything you'd disagree with there?
That's very comprehensive, actually. No, it's okay. For that question, it's
Okay, fine, good. We're all in agreement. I wanted to ask you also about, from the German investor perspective, I think in the years we've been doing, staging this event, that we've seen something of a progression from sort of initial commitments into the asset class, but quite tentative commitments as well into perhaps more conservative strategies. I wonder whether on the whole that's where the German investor base still is, or whether from your perspective you're seeing investors becoming much more adventurous and looking at different kinds of risk return profiles, different kinds of strategies, and being more open to them.
It's not a particular German situation. It's on a global basis. We cover all the regions. Look, what you see is people have become more prudent on a global basis. And prudent means they become more defensive in allocating capital, where they would like to see that really the capital comes back. The equity people are optimists. The private debt people are by definition pessimists. Equity, you have appreciation. On that, you can only lose if the capital is not coming back. So looking at the German market, the acceptance on private debt is increasing substantially. We have seen also a huge shift away from syndicated loans into the direct lending. That has to do mainly to the fact that lower volatility. and better risk-adjusted return. By the way, syndicated loans is good, but you have the best risk-adjusted return. So this is one pattern. The second pattern is it's not only the direct lending, direct lending that we see. There's also an increase in terms of real estate debt. We see there's a lot of capital going into that, and we offer such solutions. But we also see from the insurance side more capital going into infrastructure debt.
Yeah.
So in general, the appetite is increasing, and the more you understand the benefits out of this asset class, the higher the allocation become. And second is also the broader the need of other strategies is increasing.
Understood.
I think it's different answers for different groups of investors. So I would absolutely echo your implication of the question on the kind of conservatism for investors who do their first step into the asset class. I mean, they need to prove that it works. They don't want to wake up 2 years when maybe we have a market downturn event and kind of really having to report around very poor results, hits to kind of on the losses, etc. So they typically want a most conservative, first start of an allocation to ramp up their processes, see how it works, get familiar with the asset class. So I don't see that changing for people who maybe have the luxury of not having a need to invest there. But at the same time, people have broadened their scope extremely. Investors who have done that for over 10 years, who have run private equity allocations for 20 years, who have own dedicated teams selecting core direct lending funds across the globe. I mean, they're definitely looking for satellite strategies that complement their portfolios, not necessarily to enhance returns. That might be, for some, a consideration. But more generally, it's about diversifying exposure away from a relatively one-dimensional risk factor, and that is the association with the private equity market and corporate and the macro default cycle. So we're certainly seeing that appetite emerging, and there are things that are, I think, more mainstream, like real estate and infrastructure-oriented debt, even in the investment grade corridor of risk return at 2-3%, and some more elaborate strategies. But private debt extends into the double digits in terms of what can be achieved and what can help to really build a more robust portfolio.
Okay. Alexander, does that tally with what you're seeing?
Yeah, I can't support that in all aspects, but I think it's always a question which investors you're looking at, and we have very diverse approaches to that. We have an investor who says, as safe as possible, please. I only take the first out tranches of the first out, second out uni tranches. Please give me that. I have another investor who says, oh, look, I have a portfolio of some billion, and I need at least 500 million to make a difference. And so, and in this 500 million, I need really 6 to 8% net. So please give me 6 to 8% net. And if you advise him, but this means risk for 6 to 8% net, and he says, that's okay. The rest of my portfolio is perfect, and I have deliberately set on the path. And so, the others who, as Mr. Grau just said, are more diversified and said, okay, I have a well-diversified start in direct lending. Now give me the rest. What is the rest of the world and of the strategies that could make me happy in my portfolio as it is? And so it's really very diverse. I think it's a question: when did they start? When did they start to invest and to engage in that asset class? And so you have different stages.
Look, I think the issue really here is the business has moved from a pioneer or exotic phase into an institutional phase.
Yeah.
And this institutionalization is happening, and obviously there are three factors: content, process, and structure. Content, we just debated, that means that's the strategy and the return. And there's a high increase on level of knowledge. process. This is interesting to see that obviously the more experience the investor has, the more he demands on the GP side by saying, I'm not just going in your GP fund. I want to do today SMA, single managed accounts. I want to do co-investments. I want to do secondaries, an evolution which is natural. Ultimately, the institutionalization means investors care about efficiency on the investment, means a ramp, not too long J-curve effects. And the second is evergreen structure, that the money is invested as long as the investor wants, not as the GP wants. This is a super evolution that we observe. I call it institutionalization, and this is good. Lastly, to what it leads is to more governance, control. Not governance by the regulator, by the client. We observe that the validation of the data, the validation of the full process has reached a fully other level of professionalism than years before. This is good. This is really something that helps the industry to grow. And we as providers, we just have to cope with these challenges. That's why we are paid for.
Okay, on that very pragmatic note, we've come to the end of our time here. So thanks very much for joining our Germany podcast. I found that extremely interesting, and I'm sure our audience in general has too. So thank you very much.
Pleasure having been here.
Thank you
very much.
Thank you.